Average true range, ATR for short, is a way of summarizing how volatile a chart has been over a certain time period. This is done by averaging the range a chart moves according to a particular interval within the specific time period. This can, for instance, give an idea of what a typical change in price is between daily intervals over a 14-day period. In other words, the average range price changes from candle to candle over 14 daily candles. It's easy to find out about the finer details of this indicator with a quick search. Most of the material out there is explained well and illustrated with clear diagrams. Though it's less common to find a large amount of examples covering a wide range of situations with the ATR. This lesson will use a lot of real chart examples to discuss the ATR. In doing so, we can better understand this indicator's characteristics, uses, advantages, and limitations, all in practical real-world settings. General concepts and nuanced details will be seen on a variety of charts from different markets and time frames. So, no matter when you watch this or which particular charts you choose to use the ATR on, the information from this series can still be highly applicable. With charts that move to higher pricing or those that are already priced high, the value displayed for the ATR can naturally be higher when compared to other points on the chart where price has fallen, or charts that are already at lower prices that can then naturally display lower ATR values. However, ATR is not representative of percentage movement. A chart at relatively low prices can display a small ATR value even though it could be moving a lot in terms of percentage movement. Conversely, higher price charts or charts that are displayed in a format with higher units such as a stock market index can have relatively small percentage movements, yet the ATR would still naturally display large numbers. Then in a case like this, where price rises up from 58 and later falls back down to the same approximate area around 65, the ATR value can be quite different even though the chart is back close to the same price. In these cases, the ATR value is influenced more by how much price is fluctuating in the short term, rather than the current price the chart is at. ATR can help gauge the strength of a move. In this example, price falls out of this range and drops significantly. During the span of these events, ATR is relatively high compared to the periods before and after the most drastic movement. This can be seen quite easily without necessarily looking at the exact values of the ATR during this particular time period, which has a distinct peak. From June to August, ATR begins to fall and flatten. This is also the approximate time the downtrend begins to weaken. Then later, there's a moderate upswing which is also quite stable and has relatively little volatility as well. That's why the magnitude of this upswing is comparatively lower along with the ATR in comparison to the previous downtrend. More volatility with larger moves usually means instability and a comparatively higher ATR. Again, here there's a large move and acceleration to the downside and ATR rises. Then during the next upswing, there's still high volatility to maintain ATR at relatively high values, which in turn is an indication of strength for movement on the chart. In this case, it's the uptrend movement. Moving along the uptrend begins to weaken, and that can be seen quite easily with flatter movement and a slight decline, along with increasing red selling volume. What's being demonstrated here is a movement, in this case again a bullish movement with an uptrend. Then what the declining ATR can tell us here is generally there are progressively smaller movements from day to day, from candle to candle, as price begins to consolidate at these highs and begins to slide slightly. Then as the relatively range-bound movement continues into the beginning of 2023, there are a few rapid swings in price in the short term. This is of course a volatile movement, and the ATR will naturally rise, fall, and flatten as price movement on the chart naturally begins to strengthen, weaken, and consolidate. In addition to gauging the strength or weakness of movement on the chart, ATR can be useful for making approximate estimates of potential movement. In this example, nearing the end of April, an uptrend begins to lose steam, and that can also be seen with the ATR falling. Then naturally, as there's more red on the chart, there's growing bearish sentiment. In fact, volatility does increase with a potential bearish reversal, developing with some abnormally large red candles in the past few days. The hypothesis here is the early reversal can accelerate further with another large drop, either in the form of a gap or another large red candle. 73 is a short-term support with candles making lows near it. Using the approximate ATR value of 1.43 provides an approximate threshold that is eventually breached, trading and eventually closing under 73. Along with advancing well under the range of 1.43 set by the ATR, it's not too surprising to then see a bearish continuation develop this downtrend further. Once again, the strongest part of a move. In this case, the accelerating drop of the downtrend from late April into the middle of May. The bulk of a strong move can normally be within 1 to 3 ATRs. By ATRs in the plural form, this is referring to multiples of an ATR value, usually the one used to estimate the magnitude of a move near the reversal point or breakout point. In this case, after decisively going under 73, the bulk of the strong movement goes down that approximate ATR value of 1.43 once, twice, thrice, and after that, usually going past to the fourth or fifth ATR multiple will at least begin to see movement flatten temporarily, or begin to consolidate in a range and even begin to reverse eventually. As usual, the weakening of a major movement generally sees ATR decrease, such as in this case nearing the beginning of June. This next part shows a familiar short-term spike over the ATR during a strong movement. In this case, a large bullish continuation. In this case, we see an uptrend begin to weaken as price begins to flatten and even decline slightly. Notice here, after and before the major bullish continuation, ATR was comparatively lower and did not fluctuate as much, because during these periods, price was consolidating and relatively much more stable compared to the strong and volatile jump in the transition to August. Around the time this jump began, ATR was around 1.34, 1.35, no need to be super exact. In this case, accuracy down to 2 decimal places will be okay. We can say the decisive breaking point is around the 70 boundary. Once price crossed above that, it easily moved up $1.35 higher. In fact, the strongest part of the bullish continuation did this around 3 times. Then, as is commonly the case, a strong movement is relatively short-lived and soon begins to flatten just around the time price begins to consolidate to establish a hold on its current position and volatility decreases, along with a falling ATR which also eventually flattens. Limitations of the ATR can be seen with discrepancies like this where price is falling and ATR is rising, or a case like this where an upswing flattens during the same time ATR goes on a steady decline, but then it's also common to see cases like this where similarly price begins to flatten after a small to moderate upswing, while ATR could also be declining such as at the beginning of this period, but then it sharply increases before flattening again. The point is, ATR does not and is not meant to provide an indication of the direction of price movement on the chart. For instance here, ATR is in the 260s. That's just a rough indication of the range price can fluctuate from day to day, from candle to candle. It has nothing to do with the direction of price movement, but rather the potential magnitude of movement. Again, here are some more examples of discrepancies that can naturally take place between the direction of price movement on the chart and changes in ATR. For example, before the highlighted range, ATR is increasing while price falls. Then during the time span of the highlighted areas, ATR peaks and flattens for some time prior to falling, while at the same time price begins to increase. Overall, the uptrend is quite gradual. Normally, price takes a small step up each day to close a bit higher. Then here, with a proportionally large spike upwards, there's a noticeable increase of ATR in the short term during its steady decline. After that, ATR naturally begins to continue the decline as stable movement quickly returns back to relatively small fluctuations in price. Later, the uptrend continues low and steady as ATR continues to fall and flatten naturally with such small fluctuations in price for an extended period of time. But notice again here, there's a small jump in ATR for a short time due to a relatively large movement within the context of this uptrend. Except in this case, the larger movement is a drop. To reinforce the scope of ATR use and its limitation, you should remember ATR is only an indication of volatility to provide an estimation of how much price could fluctuate. The direction of price movement is not directly tied to the changes in ATR. Although it is possible for ATR to increase at the same time price is increasing, and it is also possible for price to decrease while ATR is decreasing. The changes in ATR are only due to volatility and not a particular direction price is trading towards. Divergence between ATR movement and price movement is also equally as common. Right here is an excellent case. It doesn't matter whether price is increasing, remaining relatively flat, or decreasing. ATR is affected by the changes in the fluctuation of price. ATR can drop and be relatively low when fluctuations in price are relatively small. Small fluctuations in price, as we've seen, can take place in uptrends or downtrends. Then, such as during uncertain times or indecisive times in the market price, can go up and down drastically in the short term, but remain flat overall when looked at from a longer time period. While ATR can increase significantly due to increasing volatility even as price remains relatively flat or even begins to fall drastically. See, here in the short term, these two candles here are relatively similar in size to the previous ones over the last month. But as the average true range increases a lot due to the formation of these proportionally larger candles that make up a sharp short-term drop and rebound, ATR increases sharply at this time, regardless of the direction price is moving in. Since it's the fluctuation in price, also called volatility, that is increasing, which in turn pushes ATR higher. The only setting to change for the ATR is the duration of time it is based on. Normally, this means a length of 14, which is probably the most common, and often seen as a default setting. Looking at the popular daily time frame, this means that the ATR is based on 14 daily intervals represented by 14 candles. Large movements that often significantly change ATR values often take place within a span of 14 candles in most time frames, including the daily time frame. So while the duration of 14 candles could be a short time period compared to the longer length of time some other indicators are normally based on, it makes sense for this kind of indicator for the element of volatility, which tends to change rapidly. When there are sudden and outstanding price movements, some may choose to reduce the ATR length down to even 3, with the idea to better represent quick shifts in the market that normally expand fluctuations in price to proportionately large ranges. Though due to the constant change that's always present in the market and the highly dynamic nature of volatility and the ATR, this can be helpful in some instances. But in reality, even changing the length for the ATR setting won't always be a perfect solution. Though to be realistic, ATR doesn't need to be so precise, a general indication of the range price can fluctuate in is good enough. Another common occurrence being demonstrated here is a delay in reflecting rapidly decreasing volatility after a short-term spike that could be more pronounced in a case like this, when ATR is set to a particularly short length. Certainly the length could be adjusted in an attempt to find some kind of middle ground. Common choices will be 5 and 7. Since that covers around 1 week in the daily time frame and anywhere from 30 minutes to 2 hours, depending on which interval is used for an intraday chart. 2 hours and 1 week being common lengths of time for short-term spikes and plunges of volatility on intraday and daily charts respectively. Though in general leaving ATR at 14 will be perfectly fine, it strikes a good enough balance in a wide range of circumstances. As for increasing the length, the ATR based on 20 and 22 are common choices, with the idea being to capture that duration of normally 20 and 22 trading days per month. After that, going up to 30 can still be considered short to even medium term on the daily chart, so it can still be a decent length to account for changes in volatility that happen within such shorter durations. Then going from 30 to 40 can become a bit too long of a duration to account for dynamic short-term changes. Though in select cases, especially on intraday charts with small time intervals setting the ATR length even up to the 50s, could still be acceptable. But usually setting the ATR over the 20s can produce results that lag behind what is actually happening on the chart, even if there are just minor to moderate shifts in volatility. Which demonstrates why generally using a shorter duration for the ATR at or below 20 is preferable within the widest range of circumstances. Yes, it's not exactly perfect all the time, but that would be unrealistic, especially in situations like this where a period of relatively low volatility sharply increases just as quickly as it decreases. That's why, as we've seen before, some may choose to shorten the ATR length in such cases. And that can carry over to the intraday timeframes where rapid changes in volatility often take place during the open and close of the markets. Using the ATR on a longer timeframe, like a weekly chart, along with a shorter ATR setting is possible, especially if the chart is relatively stable, but it's generally not that common. This applies even more so for a longer time interval, such as a monthly chart, which is not commonly used, especially during highly volatile periods in the market. So overall, remaining with a daily chart and the usual default ATR setting of 14 will be quite adequate. Initial observations: there was a steep sell-off from June to July. The final major drop on the last day of June displays some familiar characteristics, especially for these kinds of reversals. Without even looking at the ATR value or measuring the final major drop, there's a noticeable spike in volatility compared to the days before and after, when the overall trend was decreasing volatility. In this case, it also meant the general weakening of the downtrend. In the short term, this reflects changing market sentiment towards a brief period of indecision seen in those first few days of July. Then, while ATR remains generally unchanged, we get an indication of stability during the switch to an uptrend where the trend develops more gradually, with mainly smaller fluctuations from day to day. The third trend we look at here is another downtrend. It combines characteristics seen with the past two trends and reversals. Like the second trend, movement is overall more gradual. This can be seen in some parts of the trend where price trades into tight ranges for brief periods. Another overall drop in ATR during this time indicates something similar. in that the average change in price from candle to candle was smaller. However, similar to that last day in June, brief spikes in ATR show instability and much more rapid movement similar to the first trend. Now let's see how ATR can be applied in this situation as price is falling and flattening onto the 1880 level, which is turning out to be the focal point of a well-defined support area. Nearing the end of October, there's one of the first closes under 1880, but it's not a decisive break. From the standpoint of ATR, which is rising, some of these drops and even closes under 1880 are close to matching ATR values as they are slightly lower or higher. But even if the ranges of some of these price fluctuations during the contact under 1880 are higher than peak ATR values around 1.5, they don't meet common benchmarks to be considered strong movements, such as being double or even triple the ATR value. This can't even be achieved when the range of the drops are combined over several days. Upon contact with 1880, the chart became more neutral to bearish. Then progressively selling has been maintained at moderate to higher levels to only produce relatively weak drops in price, and producing peak ATR values that are still around 1.5. With this drop and close back under 1880, the situation is still similar to the last few times. It can be called a drop of medium strength since it is above the ATR value, but it can't be considered a strong decisive break from the perspective of common ATR criteria where a price change reaches at least a range twice that of the ATR value. Since some of the highest ATR values hover around 1.5, let's use that round number and double it to 3 to define the minimum criteria of the range price must fall to be considered a strong and/or decisive break. If the criteria is set to be more strict, it could be a range of 3 from one closing price above 1880 to the next closing price below 1880. This is of course not met. However, using less strict criteria, such as defining the drop over several days, then this can be considered a decisive break. Some other loosening of criteria could also include drops that include intraday lows of the candles rather than the closing prices, or defining the $3 range from $1883 down to $1580. And then call it a decisive break once price crosses under that 1580 threshold over the course of several days, rather than the less likely situation where in the course of one single day, price drops $3 or more to go from being above 1880 to trading or even closing under 1880. Less restrictive criteria can be beneficial in situations like this, where a decisive break is more gradual with daily price fluctuations at or above ATR values, but nowhere close to being double or triple the ATR within the short time span of one single candle. In addition, trading volume can also be somewhat deceptive as it might not match up with the ATR movements or price movements. Watching the last few weeks before the beginning of 2023, volume isn't always at exceedingly high levels, even during the decisive break under 1880, though it's consistent enough with consistent days of red selling. Then into the start of 2023, ATR continues to fall, and price movement is stable overall from the perspective of ATR, because daily price fluctuations are normally at or below what the ATR is showing. Though in relative terms, when looking at the percentage change in price, these are actually some enormous movements of falling price. In some respects, the ATR does a good job in terms of reflecting the stability of the trend and short-term periods where it slows down. However, the ATR does a poor job in reflecting relative movements as seen with these large percentages again, where the percent change in price is relatively large during these volume spikes. Then reviewing back here, another observation to be made is the difficulty that can sometimes be present during continuations such as this. Rising volatility that is reflected by the ATR does make it a challenge to identify and more precisely define a decisive break, because that initial increase of volatility can place attention on a wider area that's then highly contrasted, especially in situations like this where a downtrend leads with a more gradual break that at first glance would seem like a slower gradual movement. This could be the case to some extent with the absolute numbers of the ATR falling, but in terms of relative movements, in terms of the percentage changes in price can actually be increasing in some instances. Moreover, it can also be helpful to look at what's happening with a volume when ATR is relatively flat. This example highlights preferred characteristics that take place with a decisive trend continuation. In cases like this, these kinds of formations can take some time to form, though usually the most important parts happen relatively quickly. Ideally, the ATR can help highlight these areas, meaning a rapid price movement, in this case increases in price during an uptrend coincide with sharp increases in ATR. And the periods before and after these events show relatively unchanged price with falling or flat ATR. Then, when there are large movements but price remains overall relatively unchanged, the chart can be entering a phase of short-term turbulence that is paired with ATR, which peaks and flattens. Prior to a gradual descent of ATR values, as the market begins to stabilize towards more gradual and smaller movements, that can often be close to the same time movement becomes more defined towards a trend reversal. With a downtrend underway into the new year, let's take note of this well-defined range, which is horizontal but has a slight bearish advantage, especially with selling building up around the 210 area within the past few weeks. Then, although ATR is almost the same as this drop, it could be considered a decisive break lower because it's a relatively significant spike in comparison to the past few weeks when ATR was gradually decreasing, and price remained flat over the past few days. Also, it's a clear close under the well-defined 210 boundary. Then in the following few days, ATR begins to decrease like before, but that doesn't mean the progress of this downward continuation is over. Also pay attention to the consistent selling volume, which is actually gradually increasing as price gradually closes lower. This has been a great demonstration of how making basic observations in addition to applying the ATR indicator can explain how a major continuation can take place with what would at first appear to be a break that was not exceedingly strong when just looking at the ATR beyond the short-term context. So remember to pay attention to those smaller details that happen within shorter time periods, because decisive and even strong price movements can take place with values close to or even below the ATR, and that it's not always practical or realistic to expect major events on the chart to take place with price changes ranging from 2 times an ATR value or higher. In this situation, there's a large reversal formation. Similar to some previous examples, the definitive break is not exceedingly strong, with some of the first moves closing to a range less than double the ATR value. And as momentum begins to build using the approximate ATR value of 2 from that time price initially began to close under 135.55, we can multiply that by 3 times for an approximate range of 6, which does a decent job of defining what we can expect to be the initial strongest portion of the movement. And this turns out to be the case even though ATR values and price on the chart undergo some significant changes in a relatively short period of time. That approximate $6 range measured since the break under the 135.55 level has been reached and begins to slow down significantly. Now, as short-term sentiment goes from neutral to increasingly bearish, ATR is incidentally close to 2 again. We will define the current support around the round 128 level. And depending on personal preference, some may choose to use less strict criteria and define any movement going $2 under 128 as a definitive break and the start to a bearish continuation. That means 128 minus 2 for any movement under 126. More restrictive criteria could choose the closing price of a candle that has gone under 128. Normally, this will be the most recent candle or one of the larger red candles. Then any movement going lower by a range of 2 or more from the point of this current candle's closing price can be considered a definitive break. And here's an ideal situation, a swift drop that closes under both these thresholds. Like last time, we can triple that approximate ATR value of 2 in order to mark a $6 range that estimates where this initially strong short-term movement is likely to slow down and flatten or begin to face some opposition. Then, as this does indeed begin to take place, the 128 level can then be used as an upper threshold, which if not cleared can make it useful too. Define another range approximately 3 ATR values crossing under the 122 level, which is the level that would define a decisive break for another bearish continuation. However, in just a few days, the exact opposite takes place. And during the further development of this new uptrend, we can reuse the 135 level to conveniently define where the newest bullish movement has begun to weaken. With the chart continuing to consolidate back at these previous highs, there's the distinct characteristic of ATR beginning to fall and flatten, right after another strong portion to a movement, in this case, a brief bullish continuation following appearance over 128. Again, taking the ATR value at the time of this decisive break, in this case around the low 220s, gave us a decent approximation of where the movement was likely to begin to weaken. After the strongest initial portion moved a range of about 3 times the ATR value. Usually when there's a major short-term movement with a larger candle and/or gap, charts often settle down relatively quickly with much weaker movements in narrower ranges, commonly accompanied by decreases and plateaus in ATR. When more decisive directional movement takes place, it won't be unusual to see ATR remain at relatively low levels, but there can usually be a slight bump in ATR, even when there's only a minor to moderate break out of a developing reversal range. Now let's break down these characteristics step by step as it takes place on the chart. except in this case, it's in the context of price suddenly jumping up following the normal spike of ATR. Something interesting is happening while price does its more normal behavior of remaining relatively range-bound. ATR hasn't undergone a typical drop following a noticeable price gap on the chart. Instead, it's remained almost unchanged even after almost 2 weeks. Here's something even more unusual with another sharp increase in ATR. This indicates prolonged instability in the market. Then, as there's natural support filling in the gap for a minor rebound, ATR soon plateaus for another brief period of relative stability, similar to the few days after the gap up into the second half of April. And although some of these recent red candles have been quite large in relation to the candles around them, looking at the ATR from the time span of at least 1 month, we can see it continues to be quite flat with only a gradual rise, despite some of these more moderate-sized drops into May. Then as time goes on and persisting support keeps price up around the 130 area near the gap fill region, we can see that in the broader context, it's still been a similar situation to the first case we looked at with the gap down. Overall price has been relatively range-bound and directional movement has been quite weak for time spans beyond 2 weeks. The only main difference was volatility remaining at higher levels for a longer time after the initial gap up. That's why it's also important to take note of the broader context and other features such as the gap region around the 130 area. Then with this newest gap, it's a more typical situation with a relatively quick decrease in ATR as price begins moving into a narrower range. When a reversal progresses to get back over the initial gap down area, there are still some periods where ATR briefly bumps up slightly. Though overall, from a longer-term view, price and ATR values are not significantly changed from the start of August to the beginning of September. Again, here's another similar situation, except it's just a larger movement from one big candle and not a significant gap. ATR still drops and flattens as price tightens into a smaller range, and then there's a slight increase in ATR as there's more decisive directional movement, which in this situation is the continuation of downtrend development, rather than the progression towards a bullish reversal. These characteristics are especially applicable to the intraday time frame, particularly in the stock market where sudden larger movements take place on a regular basis, usually near opening and closing hours. In the case of a new chart of an asset just beginning to trade on the market, there will naturally be a short wait until ATR is available. Here, ATR with the usual setting at 14 requires at least 14 days to pass before the first ATR value can be displayed. Let's mark some of these levels near the highest closing prices so far. Before we get to the main topic of this example, here is a review of those familiar characteristics that usually take place during and following sudden and sharp movements. The marked area from 43 to 60 can serve as a good approximation of the main boundary into new record high territory. With the broader context defined, let's focus on this short-term development and see how ATR can be applied. With that initial green spike up, price rose well above 3 times the ATR of the time, and as we've seen before, after moving beyond the range of 3 ATRs, even an initially strong move can instantly become overextended, especially upon contacting a major resistance area such as this. This makes the current flatter price movement and drop in ATR even more natural. Then going ahead to this spike, we could expect more of the same to follow, especially with such a bearish candle. However, expectations aren't always in line with reality, and that's why it's even more important to pay attention to short-term development. The key feature here is the virtually unchanged ATR, combined with neutral to increasingly bullish movement of price. Though with this next candle, pay attention to where price closes. It's certainly been a series of strong short-term bullish movements, but there's still yet to be a closing price over 60, which is the final part of this larger boundary. And now with a more familiar ATR characteristic of flattening and falling values, more sustainable bullish strength for a decisive break over 60 gets called into question, especially with price going more bearish to neutral, which results in price being little changed, while a moderate yet stable downtrend progresses during the shallow decline of ATR. And with markets outside the stock market, which tends to have more regularly defined hours, going to an intraday time frame can still see many of these characteristics we've seen with sudden and rapid price movements, though they may not happen at regularly defined intervals such as the opening and closing times of the stock market. As the chart begins to reverse back up towards 170, we can use the average true range ATR indicator to determine this close over 170 to be about adequate but not exceedingly strong. Since the distance from the previous close is greater than even those recent peak ATR values around 6.7. However, a straight break continuing past 170 would have been more likely if the distance from the previous closing price was double the peak ATR values around 6.7 to be something over 13. though since closing prices have held over 170 and are beginning to close noticeably higher. We can take the current ATR value and place it 1, 2, and 3 times over the closing price of today to roughly gauge how high price can keep closing without any significant increases in volume. In this case, 3 times the ATR is reached and price keeps going higher because there is an injection of green volume. It's similar to the previous situation with the distance to the previous closing price around 8, which is higher than the ATR value hovering around 6. So it's again adequate to keep going higher, but not exceedingly strong. As it would be if the break over the low 200 boundary was achieved with a distance between the two closing prices at around 12 or more, rather than at 8. But even if there's a break of a key boundary, such as in this case, where the distance to the previous closing price is over double the ATR value, it won't be a decisive break unless price continues to keep closing under 197.50, and ATR maintains these peak values closer to 7. In this case, when price closes over the range briefly, it's initially not an exceeding strong break higher. For the same reasons as many of the previous cases, the distance to the previous closing price is around 6.6, so it's over the ATR value at around 5.5 to be an adequate break, but nowhere near double the ATR value, which plateaus for some time before sharply declining. This is due to another sign of weakness, where price briefly stays at these new highs, but doesn't manage to keep closing at them. For more on indicators as well as Fibonacci methods, follow Ascencore. Thanks for watching and have a nice day.